Shanghai, November 9. Chinese yuan pulled back on Tuesday after touching an 11-day peak in early trade, but moves were muted as traders focused on upcoming inflation data from the US and China for clues to the timing of interest rate hikes. Traders said while there was little room for a clear break higher given broad dollar strength, the yuan continued to enjoy short-term support after stronger than expected trade data released on Sunday. There's still upside pressure from FX sales toward the year-end, so we're bullish on the yuan and could see it touching June highs. That the Fed may not hike as quickly as imagined, said a trader at a Chinese bank. For its part, China's central bank will likely move cautiously on loosening monetary policy to bolster the economy, as slowing economic growth and soaring factory inflation fuel concerns over stagflation. Policy sources and analysts said. Before the market opened, the People's Bank China set the yuan's daily midpoint CNY per dollar prior to market open. Its firmest in nearly 2 weeks. That helped spot yuan to strengthen in early trade after opening at 6,000 per dollar, pushing it to a top of 6.38. By midday, it had softened to 6 per 39 per dollar, 28 pips weaker than Monday's late season close. Offshore yuan G3 also weakened to trade at 6.39 per dollar for Monday's close. A softening of the Hong Kong dollar, the weaker yuan was trading at 7,000, moving closer the psychologically key 7.8 level. Weakness in both currencies stood in contrast to a rally in emerging market counterparts. Ken Chuang, Chief ASEAN FX strategist at Mizuho in Hong Kong, said indebted Chinese property developers affected by intensifying worries over a liquidity crisis in the sector might be selling Hong Kong dollars to help them cope. Potentially, these developers could attempt to sell their property development projects in HK to acquire the funding to repay the USD bond, he said in a note. If the HKD spot was flow-driven, the HKD selling sold proved to be short-lived, and HKD spot will likely be kept below 7.80 handle. A think tank under China's powerful state council met real estate developers and banks in the southern city of Shenzhen on Monday. A source with direct knowledge of the meeting told Reuters. Yeah, this is the one. Daily exchange rate. This is the daily exchange rate. The Hong Kong was look American like mastering the forex. Ongoing. Ongoing violent incidents in Hong Kong mean that market participants are looking for signs of financial risk. Interest rates, which have risen since the protests began, are a good place to start. But is this all about capital flight? A mega IPO could be playing a role. Is capital flight still a tail risk? As the number of violence incidents and the level of violence in the Hong Kong SER has increased, we take a look at how the market in Hong Kong has reacted. More precisely, we explore whether the risk of capital flight has increased materially. What was changed in the market so far? The violence on the streets of Hong Kong started on 12 June 2019 and has become more frequent and more extreme. How has this changed market liquidity in Hong Kong? The starting point of measuring an economic's liquidity is its interest rates. Put simply, the higher the market risk, the higher the interbank interest rate, all else being equal. We benchmark the HIBOR to another economic's interbank rate in order to strip out the possibility that any rise in HIBOR has been driven by global events. The usual benchmark is USD LIBOR, the US interbank interest rate. The most common approach is to use the 3 months HIBOR spread as an indicator of liquidity tightness in Hong Kong. HKD forward points, which drive off these spreads, are basically another way of looking at the same thing. Not surprisingly, they have also pushed higher. The HIBOR spread was around 0 percentage points to 1 percentage point for most of the time since 2016. But this has moved from negative to positive since mid-June. Hong Kong dollar interest rates have gone up, which matches the date that violence began in Hong Kong. Is the rise in HIBOR alarming? On 20 November, the HIBOR spread was around 6 percentage points. However, this is not very high compared to previous episodes of financial stress in Hong Kong. The last time we saw a large positive HIBOR spread was back in 1997 during the Asian financial crisis. Readers may wonder why there was no spike in the HIBOR spread during the global financial crisis in 2008 till 2009. But that was because the risk originate from the US and spreads were negative. US liquidity strains were higher than those in Hong Kong. Returning to the high positive spread back in 1997, this rose as high as 10 percentage points on 27 October 1997. The path taken by the higher labor spread was very rapid from the prevailing high for percentage points in August.